So, hello and good afternoon. I welcome you to today's Trading Spotlight webinar here on Friday. It's the 16th of October 2020. My name is Jens Klatt and I'm the moderator here for the upcoming something like 45 minutes on a very interesting topic. So what we want to do today is, in fact, we want to look at the ATR, at the calculation, stop loss calculation, in fact, but also the trading range calculation for a given day. So you can already see how I use the ATR, the average true range, in my trading, in fact. And so okay. I just had a smile. So that was Katie, I think. Hi, Katie. So yeah, so let's have a look at today's agenda and then dig into this topic right away. So first of all, we want to answer the question. We want to introduce the average true range, in fact, the ATR in short. And I want to show you how it's calculated in a graphic way, in fact. And then we want to we want to look at how to use it in our trading. In fact, as a professional trader, how to use the ATR. It's a very useful tool, in fact, in our daily trading. And then we want to to show how the range is calculated, and how this calculation is in fact used in our daily trading. And then we also want to use the ATR as a stop loss calculation tool. So what I usually do is, in fact, and that's something I can already say right here, we want to look at today's price action, and we want to have a look here at how to calculate the stop loss, respectively, especially the trading range, then and in a given on a given day, in fact, and use a real time example. I think that makes the most sense then, also to guide you through the process, in fact, how to use it in your trading. And hopefully we can then add some significant value to your overall trading. That's me. So my name is Jens. I'm the moderator, as I already said, for the upcoming 45 minutes. If you're interested in my person and my vita and my experience, how I got started in trading, please feel free to check out the description box, especially if you watch this video now on YouTube. Read the interview I did together with Admiral Markets around 1 year ago. That's nearly my story. And what's most interesting, and what directly guides us to Admiral Markets here, is that I'm located in Berlin, in Germany. And why is it noteworthy? Well, that's noteworthy because Admiral Markets is a global financial service provider, especially in the FX and CFD industry, with over 8,000 financial instruments being offered, and a global provider, which really is global. So what do I mean by that? Well, it's 20 offices and more around the globe, and one is in fact here in Germany, in Berlin. So that's noteworthy because probably that's necessary to say, because my start in the financial industry was in the banking sector, retail banking, in fact. So with the traineeship, and I met several clients, obviously, back then. And what I can say is, also when especially talking to foreigners, in fact, people who were not familiar with the German language, that they were kind of how can I say that? They were kind of what's the right word for this? Shy. Yeah, but probably shy is a good word for this. So they were not really confident, and I'm really shy, in fact, when talking about financial topics in German. Then that's why do I mention that? Well, I think it's very important if you are looking for a broker, beside great commissions, great auto execution speed, and all the aspects which are directly connected to Admiral Markets. For further information, check out the website admiralmarkets.com. But in addition to that, you have a great chance to speak to someone in your native language. And I think this is a big plus compared to many other competitors in this industry. And definitely give Admiral Markets a deeper look, admiralmarkets.com, for further information on their product offering, What we want to do now is we want to get started with the average true range. And here want to have a look at this standard indicator. In fact, it's nothing customized, but something you can find in your MetaTrader right in the moment once you open the platform after having downloaded it. And let's have a look at the history first. So the average range, ATR, goes back to J. Well Wilder, who initially applied the ATR to commodity trading. And how did he get started here? Why was it for him necessary to create an indicator which measures volatility? Well, Wilder realized that the focus on the daily trading range wasn't sufficient, in fact, for the purpose of measuring market volatility. And Wilder got started in his trading in commodities, and in commodities, if you have fixed trading hours and the day closes, let's say 10 p.m. So times have definitely changed. So the longer trading hours are more and more common. But let's assume we have an opening at 8 a.m. And the closing at 2022, it's 10 p.m., which means nothing more than there's a gap now of nearly 10 hours where no trading is taking place. And that means nothing more that there's a chance that the next day the market will open at a price which is not the closing price of the day before, higher or lower. And so if you have a so-called gap-prone market, equities especially probably here, you have to take the gap which occurs into account when calculating the true range, in fact, the true trading range, which Wilder defined then. And therefore, he calculated the difference between the current high H and low L. Okay, this is important to remember once we look at it from a graphic perspective. He also looked at the difference between the previous close and the current high, and then the difference between the previous close and the current low. And what Wilder did was then he calculated the average true range over several days. So several days, this is the time span you look at. So usually the standard day, the standard aggregation usually used is 14. So ATR 14 is quite common. So therefore you look at the last 14 candles. In fact, if you have a daily chart, you look at the 14 days and then you calculate the average true range. And what we want to do now is we want to calculate the ATR graphically first. So therefore we have here our first day, and this is our S1, okay? So this is the difference between the current high and the low. And then we look at the next here, at the next example. There you have the closing price, so the previous close here, and then you have the high of the day. This is S2, in fact. And the next is you have the closing price, and there you have the low of the day. So obviously, if you're getting lower, then you have the S3 here in this context. And then what you do is you calculate the average of the true range over the desired number of periods. In this case, as I already said, default. Oh, I'm sorry, that was my MetaTrader. That is what we want to use in a few minutes then here. In terms of calculating using a real market example. In fact, you will also see that I have the ATR in my intraday charts directly below my trading chart. In fact, that's quite simple. In fact, you will see that because once you calculate your stop, I want to make sure that I'm out of the noise of the market and that I have a stop which is correct based on the ATR, based on the volatility in the market. And that brings us directly to the next slide, in fact. So the first, I already introduced it right at the beginning of this webinar. In fact, what we did is we forecast the price, respectively trading range of the day based on the ATR. The other is stop loss calculation based on volatility. So first of all, let's have a look here at the forecast of a price, respectively trading range of the day. The question we answer here is, in fact, what trading range in the traded market can be expected based on historical volatility. So to give you an example there, let's have a look here at, let's use the DAX. and by the way, this is the daily chart we want to use here, and I think this makes the most sense because we look at the daily chart, respectively daily trading range we can expect. But when you look here at my M5, you can see the ATR already there. So this is, oh, by the way, let me just do the following here. So this is the DAX 30 CFD. So CFD, and it's M5 min. So this is the chart we want to look at then for our day trading setup. For example, we want to use, in fact, an example from today, in fact. So therefore, we go over here to our trading spotlight community. If you're interested in that, by the way, then please feel free to join our community here. So we really go with a real market example from today. I haven't checked it before, by the way, so probably that doesn't make sense at all, but I'm quite confident that it will work out quite well. So TY is Traders Yard community, and within this community you can ask all your questions. If it's market related, if it's indicator related, if it's research related, you can ask the questions. Paul, Marcus, and also me, we are all of us are hosts within this Trading Spotlight webinar series, in fact. And what I do, for example, is I post 2 setups every day, one for the DAX and one for the S&P 500, based on a quite simple approach, which is not looking for generating performance, but what is looking like, I follow a clear plan. I want to illustrate how important it is to follow a clear plan every day, all day, in fact, based on a easily duplicable trading setup, which is the open range here. You can see there. And this is our trading setup for today we want to use. In fact, it's a purely quantitative approach, in fact. So what can be seen here in this context, for example, is we entered a long position today. So I could now show you a chart where I've traded the setup. In fact, so far the trade has not been stopped out, but in fact we were triggered on the long side. So far the market is moving in our direction. And what we want to use is the input around the ATR now to adopt it here on our trading setup for today. So just that you know what I'm talking about when I'm talking about trades. You can see that this is another account here, obviously, so there's no trading taking place. This is a demo account in this case, and there are no, yeah, well, there is a current position. It's an example trade I haven't closed yet. It's a Tesla short. Not sure whether this is a good idea or not, but just that you know what we're talking about then in a few minutes. Now let's move back here to the DAX on a daily time frame. Let's have a look again here in the presentation first. Forecast price trading range of the day. That's our target now. Use the ATR here. And so first of all, what I want to show you is how to include the ATR within your trading platform, in your MetaTrader then in this case. So you go here to insert, you go on indicators, and there you click on, one sec, you go here on oscillators, and there you have it right at the top, average true range. And what we use here is the standard aggregation of 14 in this case. And then we click on OK, and there we go. This is our daily trading range for today. And now what you have when looking at yesterday's candle, that's what we want to do here. You can see that yesterday the ATR here was at around 200, in fact. So that's very close, 200, 220, in fact. So currently, as you can see here, the ATR, but it's quite small. So that's the reason why I go here with the chart to just tell you that. So currently it's around 200. Here's 196.77. We rounded up to 200, in fact. And so what does this mean now? Well, that means nothing more than the last 14 days, well, since we're looking here at a daily chart, the last 14 days, the average width of one candle, so high to low of the day, including gaps which occurred, if there occurred any, the average width of a candle was 200 points. So now we want to use this information for today's trading. So what we see here is, in fact, as you can see, there's a small gap which occurred here overnight. So right now, there has been a time when the future DAX, the reference market of the DAX 30 CFD, which you can find here within the environment from Admiral Markets, when the trading hours were 8 to 10 8 a.m. till 10 p.m. German time, in fact. And then they extend the trading hours. And now the market, the DAX in this case, the future DAX already opens, even though it's very thin volume, but it opens already at 2:15 a.m. German time in this case. 1 second, please. Okay, and so you have small gaps which occur, but these gaps are nothing compared to the gaps you once saw before December 2018 when they extended trading hours. There you had sometimes days when the DAX opened with a gap of 100 points. But let's come back now. But by the way, let me just write this down here also in the chart that we don't forget it. ATR 14, as I already said, was 200p. Okay, so we make a slash daily. You can see here, obviously, it's important to note which time span you look at, because on a 5-minute chart, the ATR currently is 13, which means that the last 5 minutes, the last 14 5-minute candles have an average width here of 13 points only. So that's very important then to note here that we are talking about a daily chart. Okay, fair enough. So now what you can say is, okay, we have 200 points, which the average daily range of the last days was. And now what you can do is you can say, okay, that once the market opens, that's here around this time, and with the market now having clearly marked a low for the day, you could say, based on the information we have around the ATR, how much potential does the market have on the up or also on the downside? Yesterday is a perfect example of that. This is not a set in stone. Okay, so yesterday, for example, we had a similar ATR of 200 points, and the market here dropped right from the start of the day of around 12,900 or so, 12,950 points, to as low as 12,600 points. So we had a move here of 300 points on the downside, around 250 to 300, but nothing more than that. So we did not significantly extend this range on the downside. That's probably interesting to say for all the people who wondered whether it made sense, for example, here to short the market into yesterday's dynamic on the downside. For example, in the webinar I did for my clients, I told them that they should be really, really careful shorting the market here after this aggressive sell-off into the first minutes of trading, in fact, the first hours of trading, because the risk reward is getting more and more unattractive. One of the reasons I said that was because I know that the ATR was 200 points and that the market had already marched quite aggressively in direction here of exceeding this 200 points ATR aspect. So it's not that the market will stop there and aggressively reverse. So certainly there's a chance that the market continues to trend lower over the next hours of trading, but still it decreases the chances of a more aggressive move even or after the already aggressive sell-off then. And now let's have a look at today's price action. So we mark the low here, and from there the market starts to move higher. Again, the ATR is 200 points, and that means that the average candle of a day, so from low to high, is 200 points for the day. So what we do is we look here at 12,707, and now we add those 200 points here on the upside, giving us a good idea of where we should expect the market based on historic data, in fact, as high, or what we should expect here, where the market will potentially see an exhaustion. I mean, at the end of the day, it depends mainly now on what US equity markets will do in the afternoon. But this information here is probably, it's probably of high value, especially for intraday traders. Why? Well, because we can now say, okay, we already made a quite aggressive move here on the upside, and the potential is seems based on historic data we have, quite limited on the upside, which reduces our risk reward ratio for long engagement. So if you do not have a long position in the DAX now, the question you should wonder is, how much potential do I see on the upside, and how much risk do I have to take for this upside potential here? How much risk do I have to take here to ride this wave or to do the trade? And so now assume that you come to the conclusion that here, for example, there's your trade. That's a trade. You enter right here at 12,859. So your stop will be placed at 12,797. 97. So that's a risk of something like 60 points around, right? So 64 points in this case. So now if you say, for my trading, based on my hit rate, I know, and that's one of the reasons why a trading journal is of such high value, in fact, because you can just easily look up your trading journal and know what is your hit rate. Just assume you have a hit rate of, say, something like 45%. You have to wonder now, if I have a risk here of 60 points and I see, based on a simple calculation based on the ATR, I see a target right around 50, 60% higher, can I trade this profitably? So the risk reward is slightly below 1-to-1, in fact. So already unattractive. You probably have read several trading literature, and there you found out that usually you should go for a risk reward which is substantially greater 1, which means 1-to-1.5 or 1-to-2, for example. And so 1 even below that, it's not very attractive for a trading setup. So usually you should aim for a target which generates a higher profit than you initially risk on the trade. And this gives you a quite good idea on what to expect for the day. So surely, I mean, it would look quite great if we now see a push up to 12,900 points shortly after the US market opening, 910 points, and then the market turns there, and this is about the daily high. But this would be purely coincidentally, in fact. So what I want to give you here is just an idea of what you can expect, what you can project based on the incoming information and probably upcoming intraday trading setups you formulate. And if you come to the conclusion then here, for example, to trade a break to new daily highs, for example, here the DAX broke out at 800, as I already showed here within the trading spotlight community. Our setup was 801.51 here, based on the setup, which says we define the range between 8 to 9:05 German time in this case, and then we trade the breakout based on our identified advantage. In this case, we trade above that EMA, in this case EMA 50. If we trade above that breakout on the upside, we have a long setup. So that was already triggered, and currently the market is moving in our direction. And what you can now see is, for example, that based on our ATR, it's quite difficult to expect the market really to reach our take profit, since the take profit is another 70 to 80 points higher. Just again, here we said from the daily lows, it's another 200 points based on the ATR of 14 on a daily time frame. We should expect the market to have potential up to this point here, while here the target can be found somewhere here in this range on the upside. What does it mean? Well, what we could conclude here is, for example, to say, okay, if the market now moves in our direction, continues to move in our direction to trend higher, still we have to be careful in regards to the probably already exhausted potential on the upside. That means if we run into a region of 900 to 910, 920 points, for example, we start to move our trail, our stop more aggressively after the price here, to make sure that if the market really exhausts in this region and is not moving significantly beyond 12,900 points, that we then here don't risk the market to move aggressively against us and take back our to this point quite attractive gains we saw so far. So that's one way to use the ATR, in fact, based on today's trading action and price action. And what we can also do is we can use the ATR as a stop loss calculation tool based on volatility. So that means nothing more than we have to find out whether the stop is too tight based on volatility, current volatility, or if the stop is probably perfect. So what do I mean by that? Therefore, let's have a look again here at the chart. And let's use this example. I probably change the color here to red. That's probably a little better because there we have it. And now we use today's trading setup, and we can, oh, by the way, that wasn't necessary in fact, but however. So what we will do is, in fact, we want to see whether the stop was fine based on volatility of our setup, in fact. So there we go. So again, our setup was, we go along with a break above 801. Let's do it that way. So, okay. Can you see that? Hold on 1 second. Let me just do it that way. Let me just enlarge that. So there we go. Okay, so that's our range, in fact. Back to our setup. So we have our entry at 12,801.51, and we have our stop at 12,707.95. That's a quite wide range, in fact. So we're talking about nearly 100 points. But we define our range based on the information we get from the market. So it's not possible to decrease the size of the range, but it's given or based on market volatility, in fact. And so what we can see here in this context now is that our risk is obviously, in this case here, 94 points. So we have our entry long and we have our stop, and the distance between these two is our risk, our initial risk of 1R, in fact. So what we have here is now 94, and what we should wonder in this context is the stop fine based on volatility? And therefore, what we can do is, once the setup is given, in fact, we can have a look here at our ATR, which at this point is trading around 25 points, in fact. That means that the average, the volatility, the width of one 5-minute candle in the last 14 5-minute candles has been around 24 to 25 points. And if our stop is now smaller, so if we enter the market, let's say at 801 and our stop is 790, it's just 11 points, then we're within the noise of the market, and the chances of being stopped out is massively given. In fact, it sees a high increasing probability that we get stopped out, and that we are not stopped out due to a significant move, let's call it, a move which makes sense, or which is completely changing the market environment, switching the advantage from long to short or something, but it's just purely coincidentally. So it's just a stop out which happens due to the noise of the market and the natural volatility we currently see within the market. So and that's one other chance to use, in fact, the ATR in our trading then here in this context, and to use it as, in fact, a tool which gives an answer to the question: does my stop, the stop loss I set, given through my trading setup, does it make sense or not? And in this case, it clearly makes sense, because our stop width in this case is 94 points compared to the 25 points the ATR here is illustrating as current market volatility, or average width of a 5-minute candle for the last 14 5-minute candles in this context. And if we, let's say, have a stop which is significantly tighter, chances of being stopped out by a move which is purely coincidentally increases massively. So this is when I set my stop based on volatility, that's one way to use it, in fact, based on the current noise we see in the market, and make sure that we are not stopped out due to a move in one or the other direction, which is of no high significance, but just a result out of the overall volatility we currently see in the market. So what I have now is, again, we have a short summary, let's say, of these two techniques I just presented. Let's go through them once again, just purely theoretical. In this case, once I created this PowerPoint, we saw that the average range on a daily time frame here for the DAX was 250 points. Now it's down to 200, but it doesn't really change. In fact, here the overall idea behind how to use the ATR in our trading. So the example is ATR 14. So it's the standard aggregation again of the average range. 14 in the DAX was 250 points on a daily time frame. So this is the chart you look at, and then you draw the conclusion out of this information that the average fluctuating range of the last 14 DAX daily candles averages 250 points. So that's the width you expect the market from high to low, in fact, to move in one or the other direction given historic data. And what we do now is we assume that this range will not be significantly exceeded on the following trading day. And this is also something, again, I want to emphasize this. I want to go back here to the chart, on a daily chart, first of all, and then to yesterday's price action. Probably have seen how aggressively the DAX moved, in fact. And still, what we can see here is that the volatility that day was again around 200 points. And if we now look at the overall price action, once the market opened, let me just take this out here. Once the market opened, what we could see is, in fact, that from high to low, so we can already start a little earlier probably. So probably makes sense then to use here the high of the day, which was at 12,990, so around 13,000 points. So you now might say, okay, well, if we now go to the daily lows, we are at 200, two ATRs, in fact, so two ATR 14s, it's 200 multiplied with 2. So it's day to low, it's 13,000 to 12,600, it's around 400 points. But still, what you can clearly see is, even if we exceeded the daily range from yesterday by a factor of 2, so we expect, based on historic data, that the daily trading range will be 200 points. Still, it was only 400 points, which means nothing more that when you start the day, which will be the case, most of the time it will be the case around 9 a.m., something like that, 8 to 9 a.m., and you see the market building its trading range here and already trading from its not its opening price, but its daily highs here. Overnight price action was already bearish, and we're trading already 200 points lower. 200, 150 to 200 points lower. You don't really expect much more on the downside. And this reduces here the risk reward on the downside. That doesn't necessarily mean that you're not taking the trade anymore, but it means that you're probably more conservative when it comes to your position size. So that's one conclusion you could draw out of this. Yesterday would have been a pity because the market moved aggressively in direction of the trend. But I can say, based on my personal experience, that most of the time, the market really tends then to see a quite aggressive reversal into the day. So yesterday, probably a bad example because we did another 200 points then here from already 150, 200 points drop overnight. But still, it's something you need to take into consideration in the future, probably, once it comes to the question, how much potential do I see for the market I look at here for the upcoming hours here of trading in terms of potential movement in direction of my identified advantage, in fact. And so what we then do is we assume that this range will not be significantly exceeded on the following trading day. In other words, we add, respectively, deduct the ATR 14, in our case, 250 points, for example purposes, but also 200 points if you take the real market environment currently. We take this from the closing price of the day before to get a price limit on the up, respectively downside, as a price limit we look for. And then if the DAX 30 opens within up gap of, let's say, 200 points, for example, we assume that it only has another 50 points to go on the upside, on the downside, depending on where and which direction we gap here. And that said, we can assess for potential long trade, but also for short trade, certainly, whether the risk reward is attractive enough for our intraday trading setup, or if we have to probably, if it's an automated setup as the one I just described in our Traders Yard community, that we probably discretionary intervene here and try then to probably get more aggressive with our stop once we today, for example, reach a region around 12,900 points. And yeah, the stop loss calculation, this is several ways, or you can use several ways. The two of my favorite approaches is the stop is set based on volatility. So that's one example I haven't yet introduced to you. But what we do is that we can say we use the ATR as our calculation tool for volatility. For example, if we say that the ATR reflects normal fluctuation, the normal range, the fluctuation range of the respective market, I use the ATR, for example, as a first indication of how far away my stop should be for my trade. For example, in case of an ATR 14 of 150 points in the DAX, for example, my stop would be minimum 150 points away from my entry point. And most likely, in most of the cases, I'd also like to multiply it with 2 then and set my stop, for example, 300 points away, if it's a trade based on a daily basis, and to make sure that I'm out of the noise of the market. And the other stop loss calculation is that I use here the stop. First of all, I identify a stop level based on price action, and then I calculate the difference to my entry point, look at the ATR, my traded time frame, and then I say if the ATR in this case is lower, is less than the price action stop, or put it differently, the price action stop is greater than the ATR 14, then the stop is outside of the market noise and it's completely perfect. And I don't need to be much worried about being stopped out through market noise, let's say. If, on the other hand, it's not happening that often, but it happens. And then that's one of the reasons why you should definitely keep it in mind. If the stop is less than the ATR 14, then the stop is within the market noise. And even if it makes sense price action wise, if you say higher highs, higher lows, you have a short, long sequence, whatever, even if it makes sense from this perspective, if you position your stop, place your stop within the market noise, we face an increased probability of a random stop out. So improvement is required. I highly recommend that, and possibly you trade a higher time frame, which is more appropriate to trade, or you have to probably use the ATR as your stop calculation tool, and then use it and place your stop accordingly to the ATR based on volatility. So let's have a look here at the summary for today. So the development of the ATR, as I already said, goes back to J. Well Wilder. J. Will Wilder is also the father, let's say, of the RSI, for example. So relative strength index, also an indicator you can find in several of my research pieces, by the way, also in the traders block section, respectively technical analysis section of the admiralmarkets.com website. Sometimes I use the RSI, for example, to identify bearish divergences or bullish divergences or diminishing bullish bearish momentum. This indicator goes back to Wilder too, but also the ATR. And what he did was he initially applied the ATR to commodity trading after realizing that the focus on the daily trading range wasn't really sufficient for the purpose of measuring market volatility. And therefore, then he calculated the average range here based on the difference between the current high and the low of the day. Then he also used the difference between the previous closing price and the current daily high. And he used the difference between the previous close and the current low. And based on that, he calculated the ATR then, which is today used from professionals. For example, in the following ways. Let's put it that way. That's the way I use the ATR in my trading. So first of all, to forecast price, respectively, especially the potential of a market in one or the other direction. And then also as a tool for stop loss calculation purposes based on volatility, and to make sure that you're not placed with your stop within the market noise, in fact. Yeah, I made the trading spotlight community already a topic. So if you're interested, feel free to join our community there, to ask all your questions there. It's not only trading related, but most of the time it will be trading related. If you have questions also around trading psychology, whatever bothers you, please feel free to reach out there, ask your questions there in our Trading Start community. It's not just me, but it's also Paul and Marcus who are there, and we are really happy to answer all your questions if you might have some. And also Paul will be here on Monday for you, so don't forget to join us next time. And Paul will talk about the Swiss franc, in fact, and answers the question whether the Swissy is still a safe haven currency. So the webinar includes here, during these tumultuous times, do we still need safe haven currencies? Are they still there? In fact, what makes for a safe haven then, and also what makes the Swiss franc as a safe haven especially. And 2 p.m. London, 19th of October, so next Monday, the webinar will take place. If you're here now in the live event, in the live Trading Spotlight event, then check your inbox for the webinar link. If you watch the recording on YouTube, please leave a thumb up here, leave a comment there, I'll share the video. Also ask your questions if you might have any, in fact. Please feel free to ask them right in the chat box, in fact. And then if you want to be here in the live event, ask your questions in real time, head over to admiralmarkets.com, there to the education and webinars tab there, and there you can register for free for a Trading Spotlight webinar. And yeah, that's the website, admiralmarkets.com, for further information. Here are the contact details, and here is the risk disclaimer. So that's it from my end. I wish you all the best. Happy trading, watch your stops. Talk to you again next week on Friday, then on the 23rd of October, once again at 2 p.m. London. I really look forward to it. And now please enjoy yourself. Have a nice weekend. See you soon.